All right, today we're going to pull back the curtain on something that sounds super complicated, but is absolutely fascinating: statistical arbitrage. At its core, it's all about finding these tiny, hidden patterns in the market where, honestly, most people just see random noise. So let's get right into it.
So, let me just start by asking you a question. What if? What if you could build a system that's constantly scanning the market, not for the next big thing, but for these little temporary moments where prices are just, well, a little bit off? You know, when two things that almost always move in sync suddenly for a moment don't? Well, that's exactly the puzzle that statistical arbitrage, or stat arb for short, tries to solve.
Okay, so here's the more official definition. Now, the phrase you really need to lock onto here is mean reversion. Think of it like this. Imagine you've got two assets, and their prices are tied together by a rubber band. For the most part, they move together, but if one shoots way up and the other one doesn't, that rubber band gets stretched tight. Mean reversion is just the bet that sooner or later that rubber band is going to snap back to normal. And stat arb is all about making money from that snap. So you see, what this really is at its heart is a bet. It's a bet on historical patterns holding true. And that is a totally different way of thinking about the market, right? It's less about trying to guess where the whole economy is going and more about trusting the math. Now, we need to be super clear about something. Statistical arbitrage is not the same as classical arbitrage. Classical arbitrage, that's the textbook stuff. It's basically a risk-free trade, like buying something in one place and instantly selling it for more somewhere else. It's a sure thing. But stat arb, that's different. It's not a guarantee at all. It's a high probability bet. It's playing the odds based on a model. And because it's a bet, well, there is absolutely risk involved.
So, how does this whole thing work in the real world? It's not like someone is just sitting there making a gut call. No way. It's a machine, a systematic process. Let's walk through the gears of this, what I like to call the stat arb machine.
Okay, so step one, you just hoover up an insane amount of data. Then the algorithms sift through all of it, looking for assets that have a really strong historical relationship. These are your pairs. The moment the model sees that relationship stretch too far, boom, it generates a trade signal. The trade is executed automatically, in milliseconds. And this part is absolutely critical. There are strict risk management rules built in to cut losses if that bet starts to go sideways. It's a constant, data-driven loop. So we've looked under the hood of the engine. But what kind of strategies is this machine actually running? Let's take a look at a few that are out there in the wild. This right here is the OG, the most classic example: pairs trading. Just think about two huge rivals, like, say, Coca-Cola and Pepsi. For the most part, their stocks kind of dance together. But what happens if, for some reason, one of them has a great day and the other one has a bad one? Well, a pairs trading algorithm spots that divergence instantly. It'll buy the one that's down and sell short the one that's up, betting that pretty soon they're going to meet back in the middle. The whole trade is just a bet on that relationship returning to normal. And of course, pairs trading is just the tip of the iceberg. You have market-neutral strategies, which are brilliant because they're designed to make money whether the market as a whole is going up or down. There are factor models that look at huge macroeconomic data points. And this isn't just for stocks either. These exact same principles are being used all over the place. Forex, commodities, you name it. It's a massive, massive field. Okay, so it's really important we talk about the flip side. This is not some magic money tree. These strategies are built entirely on probability. And, well, sometimes the improbable happens. So let's get real about the dangers here. So what can go wrong? A lot, actually. First, your model could just be wrong. Or the market could change in a fundamental way. They call this a regime change. And suddenly all your historical data is worthless. Then there's execution risk. In this world, speed is everything. If you're a millisecond too slow, your opportunity is gone. And you've also got liquidity risk. That's the nightmare scenario where you're stuck in a bad trade and you can't get out without taking a huge loss. Any one of these can blow up a strategy. And this quote just nails it, doesn't it? The single biggest risk is when those patterns, the ones that have been reliable for years and years, just stop working. When some crazy, unforeseen event happens and the rules of the game change overnight. That's when these models can fail, and fail spectacularly. So, with all those risks, where is all of this headed? I think you can probably guess the answer. It's all about more data, faster computers, and way, way smarter algorithms. Yeah, the future of StatArb is basically already here. You have machine learning and AI digging through unbelievable amounts of data. We're talking everything from social media chatter to satellite images to find patterns that a human could never, ever see. And the high-frequency trading firms, they're in a literal arms race for nanoseconds, trying to execute their trades just a tiny fraction of a second faster than the competition. The game is just getting faster and more complex by the day.
Which, of course, brings us to the final, really big question. As these algorithms get smarter and faster, doing things that no human possibly could, what's left for us? As trading evolves at this incredible pace, where does the human being find their next edge? Something to think about. Thanks so much for tuning in.